Welcome back, everyone. In this last series, we'll be considering some basic terminologies in auditing and assurance. Number one concept we'll be looking at is what we refer to as the scope of an audit. What's the scope of an audit? In case an examiner asks or gives you a case study and say draft out, infer out the scope of this audit work. The scope of an audit refers to the audit procedures deemed necessary in the circumstances to achieve the objective of the audit. Now, don't forget that the essence of the audit is to express the true and the fair view of the financial statement. But to achieve this objective, there are basic procedures, there are basic necessities that must be complied with or that must be followed in a bid to achieve this objective of the audit. So, as many of all those procedures that makes up or that is aimed or targeted to achieve this objective, as many of these procedures, as many of these steps, as many of these processes that are going to be adopted or implemented in this audit work, all these are referred to as the scope of the audit. You know, there are times in which there might be source document vetting. You know, the auditor might need to check maybe the receipt, the source documents. At times there's what we call debtor circularization. There are times in which there is need to vouch assets. All this formulates the procedures, the scope of the audit. Another concept that you need to be avail of in auditing and assurance is what we call reasonable assurance. What does reasonable assurance mean? This means that the auditor must be able to express that the financial statements taken as a whole are free from material misstatement. Now listen. It is very rare or sometimes impossible that the financial statement is totally free from misstatement or from error. But an auditor must be able to identify or to fathom that this misstatement, this error is material or immaterial. If it's not material, that's immaterial, then it means it is not significant. It cannot affect the operation of the firm. Then it's not worthy of reporting. Or little effort can be geared towards reporting it. But when a misstatement, an error, a misstatement, a mistake, a misstatement or a deficiency is noted and is now identified to be material, is identified to be significant such that it can affect the operation of the firm, then the auditor must be able to express this in his report. Then, through this, the shareholders or the appointees of the auditor can know, and with all assurance or reasonable assurance, be sure that the financial statement is free from material misstatement. Another concept that we need to be aware of is what we call expectation gap. So, is what we call expectation gap. Expectation gap is the misconception and the different misconception about the role of the auditor and what auditing is meant to achieve. You know, many people actually believed, most especially layman or non-financial managers, that probably maybe an auditor is to come and catch fraud, is to come and detect fraud. No. So expectation gap is the gap between what people believes or perception of people about the role of an auditor and what auditing actually meant in real sense. For example, this could be in the form that, number one, many think that auditors' report should be directed to the directors of the company or should be submitted to the directors of the company and not the shareholders or the members of the company. No. Actually, the auditor's report is meant to be filed or to be subjected to the shareholders, not the directors of the firm. Because an auditor is expected to be appointed by the shareholders to attest to the financial statement presented by the directors. So, there is no official responsibility or obligation on the auditor to actually report to the director, no, but to the shareholders who appointed them and to the interest of the shareholder. Another misconception causing an expectation gap or gap in what auditing really means and what people perceived it to be is the misconception that the auditor's duty is to detect fraud. Actually, this is one misconception that is common to every layman, except from those, from us, from we professionals that are financially acquainted. You know, most non-financials or layman believes that an auditor's duty or responsibility is to detect fraud. No. Actually, the responsibility of the directors is to detect fraudsters in the organization. The only responsibility of the auditor is to attest, to subject, to examine the financial statements, subject it to test, and express their own view, their opinion about the financial statement, not to come and detect fraud. So these and other scenarios causes gap in reality or on feed when an auditor is actually invited to carry out his role. So, lastly, before I will round up, we'll be looking at what are the different types of audits that we could have. We have number one, private audit and statutory audit. You know, statutory audit, a public limited company is expected to audit its annual financial statement. You know, private audit and statutory audit. We have external and internal audit. We have complete audit, interim audit, and continuous audit. We have system audit and balance sheet audit. So, I want to believe you've been able to get something in this module or series. Don't forget, like and share our video and subscribe to our YouTube channel, LearnCity. Thank you.